Hi, my name is Jeremy Zirin and I cover real assets for Marquette Associates. In this series of Alternatives 101, I will be covering infrastructure. For the agenda, I will begin by discussing what infrastructure is, followed by the benefits, and lastly, how to invest. Infrastructure is commonly referred to as the backbone of an economy because it is a prerequisite for sustainable economic, industrial, and social growth and development. Once operational, some of the commonly accepted attributes of infrastructure assets include an essential service to society, inflation protection, long asset life, low elasticity of demand, monopoly or quasi-monopoly, regulated oversight, and stable and predictable cash flows. Infrastructure assets are commonly defined by their physical characteristics and grouped into two main categories, economic and social infrastructure. However, these two main categories encompass a broad array of sectors, examples which are illustrated in the table. Within economic infrastructure includes transportation assets such as airports, bridges, and roads. Also energy and utility assets including electricity generation, natural gas, pipelines, and renewable power such as water, wind, and solar. Communications assets include things like broadcast towers, cable networks, and mobile towers. And within social infrastructure, it's common to see project financing with hospital systems and schools that are often structured as public-private partnerships. Economic infrastructure assets can be further separated by their economic characteristics, specifically the demand and supply dynamics of each type, including throughput, regulated, and contracted. Throughput assets, also typically GDP sensitive, derive income per usage, and prices are determined by the operator and owner. Examples include roads, airports, and rail. Regulated assets derive income from users, but prices will be determined by a regulatory body, usually a government, and the asset owner has some degree of protected pricing power. Examples include utilities, water, and gas. Contracted assets are operated by a contract between the operator and an entity, usually a government or private body. The contract determines the pricing system and identifiable revenues of the asset. Examples include schools, satellite networks, and broadcast towers. The stage of development at which an investment is made is a critical determinant of the risk-return profile of a project. Existing assets currently in operation are generally referred to as brownfield, whereas new assets under development are known as greenfield. There is a significant need for infrastructure projects and assets across the globe. The world's population is expected to grow on average 1% per year until 2030. Growth in population brings about construction of infrastructure and services, but at a cost. It is projected that 3.8% of the world's GDP is needed for infrastructure investments in electricity, railroads, and water per year. An equally rough calculation suggests that the current period through 2030, total cumulative infrastructure requirements across the sectors in this graph would amount to about $95 trillion. From a risk-return perspective, private infrastructure, represented by the MSCI Global Infrastructure Index, compares favorably in contrast to bonds, U.S. and non-U.S. equities. Since inception of the index, the first quarter of 2009, private infrastructure has returned an annualized 11.1% return with a low volatility as measured by standard deviation of 3.7%. Equally important is how infrastructure can help diversify a portfolio. Using correlation analysis, we can examine how an allocation to infrastructure can enhance the diversity of an institutional book of assets. From this table, it is apparent that infrastructure has a relatively low and in some cases negative correlation to bonds, real estate, and equities. This chart looks at the historical income and capital appreciation of the MSCI Global Infrastructure Index. In addition to attractive total return, we anticipate the asset class to continue to provide investors with a high and stable cash yield, as a large proportion of infrastructure assets receive their revenues from contracts or serve a regulated market. Although there are many factors to consider, in general, the returns from infrastructure assets lie along a continuum with lower risk, lower return, such as brownfield, public-private partnership, availability payment at one end, and higher risk, higher return, such as greenfield assets subject to great demand risk at the other end. This chart illustrates this relationship. Qualitative arguments for investing in infrastructure include a growing opportunity set. The glaring need for additional infrastructure investments in the U.S. and abroad should create opportunities for attractive investment returns. Infrastructure is a long-term investment and therefore well matched for a long-term liability such as the pension fund. As cash flows tend to be more static, the pricing and value of the assets are relatively more stable than other private market assets. And potential hedge against inflation. Revenue streams can be linked to inflation through concession agreements, long-term purchase agreements, or governed by regulatory regimes. Thus, as price levels rise, the revenues associated with infrastructure assets will also rise, therefore preserving the real value of investment. Institutional investors can access infrastructure through a variety of investment options, including private open-ended funds, private closed-ended funds, private co-investments, direct investments, private fund of funds, public open-ended vehicles, or listed closed-ended funds. Infrastructure can be accessed through the private markets known as unlisted, as well as public markets known as listed infrastructure. Some of the advantages of investing in unlisted infrastructure include greater opportunity set, direct investing, and more control. Some disadvantages may include limited liquidity and high capital requirements. On the listed or public market side, advantages include investments are traded on an exchange, transparency, and more liquidity. Some of the disadvantages include limited opportunity set, indirect exposure, high regulatory parameters, and exposure to market volatility. There are a variety of risks that may adversely affect infrastructure investments, and institutional investors must properly evaluate the inherent risks before investing in the asset class. Broadly speaking, these risks fall under three categories, including fund level risks, which include potential concentration, currency, financing, liquidity, and valuation. Systematic risks such as demand, inflation, political, public perception, and regulatory, and unsystematic risks such as environmental or obsolescence. In conclusion, infrastructure may provide diversification, uncorrelated cash flows with other asset classes that are well matched for long-term time horizons, and further diversification by revenue generation, sector, and geography. There is a growing need for infrastructure improvements across the globe and strong demand for private investments that we believe will bode well for the asset class in the years ahead. Thank you for watching, and I hope you have a great day.